President Donald Trump's controversial Liberation Day tariffs have hit a significant roadblock. These tariffs, initially imposed on April 2nd, were designed to impact a wide array of imported goods from various trading partners. However, their swift implementation has now been unexpectedly halted. A U.S. federal court, specifically the Court of International Trade, located in Manhattan, delivered a crucial and closely watched ruling on this matter. The court determined that President Trump overstepped his executive authority in the process of imposing these sweeping tariffs. This decision directly challenges the administration's assertive trade policies. It also sets the stage for what could be a potentially lengthy and complex legal confrontation regarding the precise scope of presidential powers in the realm of international trade. The ruling has immediate and significant implications for countless businesses that have been anxiously awaiting clarity on these proposed import duties. The White House did not take this judicial decision lightly or without response. Officials from the administration quickly announced their firm intention to appeal the court's ruling. This swift action means that the legal battle over the Liberation Day tariffs is far from concluded. The administration remains steadfast in its belief that these tariffs are essential for national economic interests. It has indicated that it could escalate the case to the U.S. Supreme Court if that becomes necessary to defend its position. Such a move would ensure that the debate over these tariffs and the underlying trade philosophy continues at the highest legal levels within the United States. This ongoing appeal process introduces a period of sustained uncertainty into the global markets. Businesses and international trading partners must now monitor these legal proceedings with heightened attention for any future direction or resolution. The Liberation Day tariffs were presented as a key component of President Trump's broader economic agenda. He has often stated that such protectionist measures were vital for shielding American industries from what he describes as unfair foreign competition. The administration also aimed to utilize these tariffs as a powerful form of leverage in its international dealings. They sought to rebalance global trade relationships, which President Trump has frequently characterized as being detrimental or unfair to the United States over many decades. However, these protectionist policies have been met with considerable debate and widespread criticism from various quarters. Many economists, business leaders, and international organizations warned of potential negative consequences. These included the likelihood of retaliatory actions from other countries, leading to trade wars and increased costs for American consumers and manufacturers who rely on imported goods. The immediate practical effect of the Court of International Trade's ruling is a significant pause in the tariff timeline. The tariffs, as originally planned and announced, cannot go into effect for now. This judicial intervention serves as an important and visible check on executive power, particularly within the complex and often contentious domain of international trade regulation. The court's detailed judgment underscores the specific legal frameworks and statutes that govern U.S. trade law. It specifically called into question the president's ability to enact such broad and impactful tariffs without more explicit and clear authorization from the United States Congress. The focus of this entire saga now squarely shifts to the appellate courts. The outcome of the administration's appeal will be absolutely pivotal for the future of these specific tariffs and potentially for the direction of U.S. trade policy more broadly in the coming years. News of the tariff blockage by the U.S. court sparked immediate and decidedly positive reactions across European stock markets. In early London trading on Thursday, May 29, 2025, Europe's Stoxx 600 index, which serves as a broad benchmark for European equities, climbed a noticeable 0.3%. This upward movement in share prices indicated a collective sigh of relief from investors and business leaders situated across the continent. Many European companies, especially those operating within export-oriented sectors such as automotive and manufacturing, had been bracing themselves for the potentially severe negative impact of the proposed U.S. tariffs. The court's decision, therefore, provided a welcome glimmer of hope. It suggested that disruptive new trade barriers might be averted, at least for the time being, fostering a more stable trading environment. This nascent optimism spread quickly through European trading floors, providing a boost to overall market sentiment and share prices. Across the Atlantic, U.S. stock futures also experienced a significant and encouraging surge following the announcement. S&P 500 futures, a key indicator of anticipated market direction in the United States, climbed a robust 1.6%. Nasdaq futures, which represent the technology-heavy exchange, rose by an even more impressive 2%. This strong positive reaction clearly reflected a wave of optimism within American financial markets. U.S. businesses, particularly those that are reliant on intricate global supply chains and substantial international sales, warmly welcomed the potential avoidance of new costly import duties. The technology sector, a major component of the Nasdaq index, also received an additional boost from strong earnings reported by influential companies like Nvidia, further fueling the impressive rally in futures trading. Asian markets enthusiastically joined the global rally, posting significant gains as trading sessions opened across the region. Japan's Nikkei 225 index, a leading benchmark for Asian stocks, saw a substantial increase of 1.9% by the close of trading. South Korean shares performed exceptionally well, with the Kospi climbing 1.9% to reach a notable 9-month high, indicating strong investor confidence. In China, the blue-chip CSI 300 index also firmed by a respectable 0.6%, reflecting positive sentiment in the world's second-largest economy. These widespread gains demonstrated considerable relief across Asia's major economies. Many Asian nations are heavily dependent on their export sectors, with the United States representing a critical and often indispensable market. The looming threat of new U.S. tariffs had cast a long and worrying shadow over regional economic prospects, and the court's unexpected decision provided a much-needed reprieve. Interestingly, Britain's FTSE 100 index presented a notable exception to the generally euphoric market trend observed elsewhere. The London-based index registered a slight dip in value, down 0.1% in early trading. Market analysts have quickly moved to suggest a nuanced and specific reason for this particular divergence from the global pattern. It is theorized that countries like Britain, which have already successfully secured specific bilateral trade deals with the US, might find themselves at a relative disadvantage if the broader, more punitive tariffs are ultimately reversed or permanently blocked. Britain was notably the first major nation to finalize such a comprehensive trade agreement with the Trump administration. Discussions are reportedly scheduled to take place as early as next week to explore ways to expedite the full implementation of this existing bilateral deal, highlighting the intricate complexities of navigating these evolving global trade dynamics. The US dollar exhibited notable strength in currency markets following the court's ruling on the tariffs. It appreciated significantly against traditional safe haven currencies, which investors often flock to during times of uncertainty. For instance, the dollar gained nearly 1% against the Japanese yen in initial trading activity, before settling to a still respectable 0.3% gain later in the session. It also rose approximately 0.4% against the Swiss franc, another currency typically viewed as a safe store of value. This movement in the forex markets typically signals a risk-on sentiment among global investors. This means that investors are feeling more confident and are willing to move capital away from perceived safety when immediate geopolitical or economic threats appear to diminish. The blocking of the tariffs reduced fears of an escalating trade war, thereby encouraging this shift. In contrast to the US dollar's pronounced rise, the euro experienced a slight downturn against its American counterpart. The common European currency dropped by as much as 0.7% against the US dollar at one point during the trading day. It later recovered some of these initial losses, but remained down approximately 0.2% as markets processed the news. While European stock markets rallied on the tariff development, the currency movement told a slightly different story. A strengthening US dollar often exerts downward pressure on other major global currencies, including the euro. The relative improvement in the US economic outlook, now seemingly free from the immediate threat of damaging new tariffs, likely contributed significantly to this currency dynamic. Furthermore, specific European central bank policies or recently released economic data from the Eurozone could also have played a contributing role in the euro's performance against the resurgent dollar. U.S. Treasury yields, which generally move inversely to government bond prices, trended noticeably higher in response to the news. The yield on benchmark 10-year Treasury notes, a key barometer of investor sentiment and inflation expectations, increased by 4 basis points, reaching 4.52%. Longer-dated 30-year Treasury yields also held firm, remaining above the significant 5% mark. This rise in government bond yields is a common occurrence when positive economic news emerges that reduces perceived risk in the market. Investors tend to sell safer government bonds, causing their prices to fall and consequently, their yields to rise. They then often redirect these funds towards assets perceived as riskier, such as equities, which offer the potential for higher returns in a more optimistic economic environment. The bond market's reaction signaled reduced demand for traditional safe haven assets. Commodity markets presented a somewhat mixed picture in their immediate response to the tariff news. Gold, traditionally viewed as a safe haven asset and an inflation hedge, saw its price dip slightly. The precious metal fell by 0.2%, with prices settling at $3,283 an ounce. This decline is consistent with an increased risk appetite among global investors. When economic uncertainty lessens and market confidence improves, the appeal of holding non-yielding assets like gold typically diminishes. Conversely, oil prices extended their recent rally, continuing an upward trend. Brent crude, the international benchmark for oil, rose by $1 to trade at $65.9 a barrel. U.S. West Texas Intermediate, or WTI, crude saw a similar increase in price, rising to $62.84 per barrel. This ongoing surge in oil prices was primarily attributed by analysts to separate pre-existing supply-side factors, including OPEC, plus maintaining its current output policy, and U.S. actions regarding Venezuelan crude exports. Market analysts and economists have been quick to offer their interpretations of the court ruling and its market impact, often expressing views tinged with significant caution. James Leong, the chief executive officer at Grasshopper Asia, a financial advisory firm, described the immediate market reaction as a temporary sense of relief. However, he also strongly emphasized that considerable uncertainty continues to cloud the overall economic outlook. Mr. Leong warned that market turbulence, which has been a feature of recent times, could easily reignite. This potential for renewed volatility is likely to persist until the U.S. Supreme Court, if the case reaches that level, provides a definitive and final ruling on the legality of the tariffs. His comments serve to underscore the fragile nature of the current market optimism, with experts recognizing this court decision is just one step. Analysts from the influential investment bank Goldman Sachs shared a similarly guarded and nuanced perspective on the developments. They pointed out in a research note that the court's order does not necessarily block all forms of tariffs or trade restrictions. Sector-specific levies, for instance, might still be permissible under existing laws. They also noted that President Trump and his administration have other legal avenues and executive tools that they could potentially pursue to implement tariffs or similar trade measures. Goldman Sachs analyst Alec Phillips wrote in a note to clients, "This ruling represents a setback for the administration's tariff plans and increases uncertainty, but might not change the final outcome for most major U.S. trading partners." This assessment suggests that the ongoing trade policy battle may shift its focus or tactics, rather than come to a complete conclusion. The court's decision to block the Liberation Day tariffs has also had a discernible influence on market expectations regarding U.S. Federal Reserve monetary policy. The perceived probability of an interest rate cut by the Fed in the near future has diminished following the ruling. According to current market pricing, the chance of a rate cut occurring at the Fed's July meeting is now estimated to be around 20%. For the subsequent September meeting, the likelihood of a rate reduction stands at approximately 60%. These probabilities are notably lower than they were just a month ago. Previously, a September rate cut by the Federal Reserve was almost fully priced in by the financial markets. Recent minutes from Fed meetings had revealed concerns among some policymakers that President Trump's proposed tariffs could fuel persistent inflation, making future rate cuts less likely if those tariffs were indeed implemented. Looking ahead, the broader economic and political implications of this ruling are undeniably substantial and far-reaching. The decision by the U.S. Court of International Trade is a very significant development in its own right. It directly impacts the ongoing and often heated debate surrounding the direction of U.S. trade policy and, critically, the extent of executive authority in this area. While global markets have reacted with a degree of initial positivity and relief, the path forward remains fraught with considerable uncertainty. The White House's stated intention to appeal the ruling and the potential for eventual Supreme Court involvement means this complex issue will continue to unfold and capture attention. The ultimate resolution of this tariff dispute will undoubtedly have far-reaching consequences for international trade flows, global economic growth prospects, and diplomatic relations for many years to come.